Hi, this is Brian, and I just wanted to share with you a video that we've created. We think that financial planners should be using professional lifetime cash flow planning software. And as part of the work that I'm doing with one of my clients, we did a demonstration with a firm in the UK called Presswood Group. Presswood runs a piece of software called Truth. It's a piece of software that I've been using for probably 10, 15 years now. And the demonstration that we did for the client was, I think, so useful that it just seemed like something that we should be sharing with everybody. So we've put this together. I hope you enjoy it. And at the end of the video, you'll see some contact details for us. So if you want to have a chat about lifetime cash flow forecasting, lifestyle financial planning, and what we're up to at Beyond RDR, then please give us a call and get in touch.
So I'll just take you through and open a client. So there's a demonstration client in the system, which will just allow me to show you around how the system works. And this is Michael and Jane client here.
Good.
So this is the fact find here. So it's really a data entry hub for the software, and it displays all the information you have in the system for the client. It allows you to review that information and add new information. But it works very similarly to Outlook. So the way the software used to look, this was just two lists, a list on the left and a list on the right. And now what we have on the left-hand side is a series of folders. So just like in Outlook, you have inbox at the top. We have the entire fact find here at the top. And when I click on that, we're displaying absolutely everything we have in the system for the client. So this is people, it's houses, cars, expenditure, employment, policies. If I click on any of these folders on the left-hand side, we're effectively filtering the list. So if I click on policies, for example, we're just looking at the 6 policies that this client has. If I click on pension, we're just looking at the 3 pensions within that sub-list of policies. So this is what they're spending on holidays. So they're currently spending £3,000, and that's an annual expense. They're spending £3,000 a year on holidays up to retirement. And again, this is that key date, that floating date that we can vary from the cash flow. This is going to increase with RPI. And then when they reach age 60, they're going to triple their spending on holidays. They're going to spend £9,000 per annum on holidays up to age 80. And then from age 80, they're going to stop going on holidays. So what this allows us to do is to just look at the different expenses and how they're affected by retirement. So again, going to the example of customers who come to us and say, well, my client's currently spending X, they want to spend Y in retirement. They're currently spending £90,000 a year. They want to spend 75 in retirement. Great. Okay. But where's that £15,000 saving coming from? What's going up? What's going down? What's going to be affected at retirement? What might be affected earlier or later?
Okay, I have 2 questions.
Yes.
First of all, can you add a one-off expenditure for a holiday?
Absolutely.
For example, if when you're 50 or you want to go on a long holiday with your children.
Absolutely. So you just have a single frequency expense.
Okay.
And what you see is that all the subsequent options just disappear.
Okay. And if you can go back to the frequency again, how many expenditures can you have? Annually? All right. There's no limit.
No.
Okay, that was the first question. The second question: description, holidays. I
Yes.
see that you have eating out, Jane's clothing, and so forth. Can you organize the description yourself so it's not
No.
Okay, good. Because of the fact there are different kinds of software applications, both in Sweden and South Africa. I know that adds together different kinds of expenditure and collects housing costs as the one group and so forth.
I mean, it's entirely up to you. So the descriptions are just a piece of text, but actually the headings under which these items of expenditure are classified, again, are completely customizable by you. Okay. So we have within the system 4 catastrophes built in. That's the premature death of the client, premature death of the partner, premature disablement of the client, and premature disablement of the partner. And in each of those catastrophes, we can look at varying any income, any outgoing, and any asset, and the behavior of that for those catastrophes. So we're looking, for example, but in this case, what we're saying is that if Michael had died yesterday, Jane would continue going on holidays, but she'd only spend 80% of what she's currently spending on those holidays.
Yeah.
But equally, we can go up, we can go down. So Michael might not like flying. Jane might have been suppressing the urge to go to the Caribbean every 6 months for the last 30 years. She might say that if Michael were no longer around, she'd spend more on holidays, and she'd want to account for that when we're looking at our life insurance requirement.
Okay. Is it possible to the what if scenarios? Is it possible to have that in the if you close that window down that you have up now and you have just have the expenditures? Is it possible to see what is the what if scenario?
Yeah, absolutely.
Expenditures.
So you see at the top here, we have this these two options. So we have a scenario view button, and that will show which scenarios each item features in. And you can see here I've got 2 scenarios for this client, and all the items feature in both scenarios.
Okay.
We also have a catastrophe view button. What that will show is the what if percentages for all of the items. So you can see here, for example, we've got long-term care costs, which are only going to feature in the event of either client or partner being disabled. We've got some help in the home here, which we're looking at in the event of Jane died only. And you can see how each of these are affected by any of those catastrophes.
Good.
Excellent. Okay. So moving on. I mean, the idea is that the software can effectively now be navigated without using the fact find. So previously, most of the things you want to do, the planning exercises, the modelling exercises, were driven from the fact find. Effectively, the fact find can be dismissed now, and actually, about 6 months ago, we added the facility to close it down completely. So it's there in the background. The client is still open. But we can drive the meeting from the main planning statements. And the main planning statements are these 4 at the top. So the net worth, which looks at the client's assets and liabilities, income, which looks at their inflows, expenditure, which looks at their outflows, and then the cash flow, which pulls those 3 aspects together. So if we start with the net worth, all of the statements are now driven in exactly the same way, using these controls on the left-hand side. So we can display the information in chart form. So this is the composition of the client's assets at the moment. And we can display a lifelong chart. And the lifelong chart shows us the way in which their asset composition changes throughout the rest of their life. We're currently looking at the semi-detailed view. So we can change the level of detail on the net worth. So we can look in full detail, which will show each individual asset. And again, we don't need to go to the fact find to drive the meeting. So it's really the opportunity when you're going through these statements to review the information that you have in the system for the clients in terms of their assets, in terms of their income, their expenditure, and give the client the opportunity just to validate the input that you put into the system. Lovely. So we can flick through the years. We can choose any particular year. So if you click on this calendar icon here, we can look at any particular tax year. We can look at any age. And we can look at any key dates. So these are those key dates again in the system. So if I click on retirement here, this will jump us straight to age 60. So from a cash flow perspective, what we're interested in is the liquid capital, whether they've got enough money in the bank or in their savings or in their investments to facilitate all of the things they want to do with the rest of their life. If I just walk through the income statement. So we have the income tax analysis. Obviously, this is based on UK tax rates, but you can set up your own tax packages if you wish to do so, both in the UK version and in the EU version. So we calculate the income, we calculate any allowances, and then we work out their taxable income and any tax payable. But really just in terms of, again, providing the client the opportunity to validate the data we have in the system. These are often the figures that mean most to the client. So, how much do you have left after tax, after national insurance, per year, per week, per month? Do these figures look pretty much okay in a ballpark? So do you have roughly £8,000 after tax and national insurance to spend per month? And if not, obviously there's something that we need to review in terms of the assumptions that are fed into the system. But what this then gives us is this lifelong expenditure chart at the bottom here. And again, I'm just going to have a look at that in more detail. Because as I say, the software is heavily expenditure driven. And what we're looking at is trying to produce a lifelong cash flow for the client, which shows whether or not they can afford to do the things they want to do with the rest of their life. And if we're just making blanket expenditure assumptions, we're not really looking at the things they want to do. And really the first step from that towards a cash flow. So we can look in the income statement at their lifelong income. We can look at the expenditure statement at their lifelong expenditure. And as I say, from a cash flow perspective, what we're interested in terms of their assets is this liquid capital figure. So this £530,000. And what we're doing from a cash flow perspective is we're taking this liquid capital, we're looking at any growth on that, we're taking their lifelong income, we're taking their lifelong expenditure and projecting all of those things forwards up to whatever point we've decided to project. Looking at whether they can afford to do all of the things that they want to do. And in this case, hopefully this is fairly straightforward. No, they can't. According to all the assumptions that we fed in, they would run out of money at age 74. What this does show, though, and just jumping back to the expenditure for a second, what you may notice here is there's a large motoring expense, this yellow chunk here next year. £150,000. Michael is buying himself an Aston Martin. Reason why I've built this in, if we look at this tab here, income and expenditure, this will show us their inflows and their outflows for each year of the cash flow and which one is greater. So you can see pre-retirement here, they're pretty much okay. In retirement, they're spending more than they've got coming in. And what I've done is I've set up a deliberate overspend next year just to illustrate how the cash flow works in that situation. So you can see next year, and we've got a nice summary down at the bottom here. This year, they're spending slightly beyond their means. Next year, they're overspending by £152,000. And that's almost entirely their motoring expenses. So Michael buying himself this car. What the cash flow shows is not whether or not they've got, kind of the money in the bank to do that. What it's showing is that, look, you've got enough liquid capital. Again, we're starting from that £540,000, that liquid capital we see on the net worth. Could they afford to buy themselves that car next year? Well, yeah, in reality, what they're going to need to do is draw some money from their ISAs, from their savings, from their investments in order to facilitate that purchase. But could they fundamentally afford to buy a £150,000 car next year? Yes, they could. Their liquid capital takes this hit. We can see their liquid capital dropping down there. But they can fundamentally afford to buy the car next year. What they can't fundamentally afford to do is all of the other things they've told us they want to do for the rest of their lives. So this is the point really where the cash flow comes to the fore, and we can look at potential solutions for the client from here. So we can have within the software up to 8 modeling scenarios. We do advise keeping it to a minimum. If you end up with 8 scenarios, it can become confusing for you and for the client. But if I just switch to another scenario, what we can do is we can make changes here with complete impunity on the client's current position. So any changes we make here aren't going to affect where the client is now. And it allows us to show a before and after picture of the effect of our recommendations. And at any stage, in the bottom left-hand corner here, we have a tool that allows us to overlay charts. So we can show the difference between any 2 scenarios just by clicking on that option there. So we can see at the moment the 2 scenarios are identical. There's absolutely no change on the chart there. The first thing I'd like to show you, down at the bottom here, we have the key dates. So again, these are the retirement age for their pension. It's the age on which they stop working. It's the age on which, for example, their holiday expenditure goes up. And moving any of these around, it's literally just a matter of dragging and dropping. Moving any of these around will instantly recalculate all of the assumptions that are based on that date. So this date here, this retirement date, if I were to drop that, for example, at 62, 63, and what we'll see is the impact of the client working for an extra 3 years. So that's 3 more years of earnings. It's 3 years less expensive holidays. It's 3 years more pension contributions. It's 3 years more growth on the pension before they start to draw from it. So all of those things are recalculated instantly.
Does this mean that both of them, both Jane and whatever his name, Michael, they retire at the same age?
Completely up to you. So you could set up a separate date for Jane's retirement, and I'll just illustrate how straightforward that is. So in the settings here at the top, this is where we create new scenarios. So to create a new scenario, you click to add a new scenario. You can see here we've got a key date called retirement. We've got another one called holiday home, another one called Aston Martin. If I wanted to have a separate one for Jane's retirement, I can just pop in a new date. The software will calculate for us when any events occur. So if we wanted this to be at Jane's age 65, let's say she loves her job. Jane's age 65, we can pop that in. And we've got a date there now called Jane's retirement.
Yep.
We can apply that either from the fact find or directly from the cash flow. So just to illustrate how we do that, if I now go to the assumptions tab, and this is the tab that I was talking about before when we were looking at when we're talking about where we show a client a list of all of their inflows, of all of their outflows. So you can see here I can toggle between showing the inflows and the outflows, which is what we're doing at the moment. Just the inflows or just the outflows. This is, you know, what they're spending on their Sky TV bill, when it starts, when it finishes, you know, all of those constraints. But if I just show the inflows, for example, for a moment, what we can see is, what do we have? Jane's salary. There we go. So client widgets limit Jane's salary. You can see that's ending on our retirement key date.
Yep.
If I wanted that to end on Jane's retirement instead, you see in the top right hand corner here, we have our key date toolbox. What I'm going to do is I'm going to select that, and you can see here we've got a key date called Jane's retirement that I've just created, and I'm just going to drag that and drop it. And you see now Jane's salary ends at Jane's retirement, whereas Michael's salary ends at Michael's retirement.
Okay.
And if I go back to the capital chart, what we'll see is that a new annotation's appeared a couple of years later, and now we can move those two independently. So if Jane hates her job and wants to retire earlier, you can show the impacts of moving those, and they can now move independently of each other. So again, you know, all of these tools down the left-hand side of the cash flow look at potential different solutions for, you know, any cash flow shortfalls. They also allow us to go the other way. So if the client has more than enough money and a situation that, you know, kind of a lot of the customers are in, how can we look at coping with that? You know, the client might not want to end up with £2 million at age 100. As I say, what we're looking at here is their liquid capital. So that starting point of £540,000 is their savings, their investments. It's not their business. And, you know, if you recall earlier when we were looking at the net worth, you can see here all the way through at age 100, they've still got their business. They've still got their house. You know, could we potentially look at releasing some equity from their business, from their house? And if so, how much would we need to release? And this is where the tools come in. So we have a more inflows calculator, and we don't label this. So people often phone us and say, how do we model equity release in the software? How do we model sale of a business or an inheritance? It's all very much the same thing. What we're looking at here is a tax-free lump sum of income that either the client or their partner is going to receive. And the software will calculate for us what the value of that would need to be to prevent their cash flow dropping below any point that they're choosing. So we can just say, well, let's not let you run out of money. Or we could say, let's not let you run below £50,000, whatever the client's comfortable with.
Yeah.
We can look today, we can look at any point in the future. So if we said, for example, at retirement at age 60, and again, you know, that's a flexible date. If I'd moved that to 63, we'd be calculating at 63, 65 would be calculated at 65. How much would they need? There's a tax-free lump sum, so this could be downsizing the house, it could be releasing some money from the business, selling the business, it could be equity release from the property, it could be an inheritance. They'd need £302,910, so £218,829 in today's terms. We can show that. And there we go. So, you know, our recommendation might be at age 60, sell the business. I'm just going to remove that and show you the maths behind the cash flow. So you see here, this is the column that we're interested in here, the balance of surplus account column. It's about the 7th column across. I'm not sure if you can see my mouse cursor. So what we can see is that their inflows, we have their inflows, we have their outflows, and you can see that their outflows are about £10,000 more than their inflows this year. We have this balance of surplus account column. So if the client's spending more than they've got coming in, what we do is we offset this against their capital. And you can see next year when they've bought that Aston Martin, that surplus has gone down to minus £170,000 odd.
Yeah.
If we double click on that year, what we'll see is what the software is doing in terms of their capital for next year. We can see that at the start of the year, they've got a surplus of £9,000. At the end of the year, they've got a surplus of £170,000 from buying that Aston Martin. So what we're looking at, we've not withdrawn money from the bond. We've not withdrawn money from their savings or their share portfolio. All we're doing is we're offsetting that by this overdraft. So the net capital position is as if they'd spent that £10,000 and then bought the Aston Martin. So you can see that effectively what we've still got all of those assets there in the background. and then we've got an overdraft to offset that. So the capital position is exactly the same as if you'd drawn the money out of those accounts and used it to buy the Aston Martin.
Explain this to me. Where does that money come from? Where are they making their withdrawal?
Well, they're not currently making a withdrawal. You could show them making a withdrawal. So you could put, for example, a withdrawal from the Halifax account. So we could say that the Halifax account is closed that year, or on the day that they buy the Aston Martin. But we don't need to do that. So the idea is that the software will allow you, with complete impunity, to just go to the cash flow and see whether they can afford fundamentally to do those things without necessarily needing to go in and say where the money's coming from.
But let's just pause there, Adam, just because I think Thomas needs to just get his head around this while he's thinking about it.
Yes.
And if I can just add to the conversation slightly, in South Africa we've got a tool at the moment automatically decides where that cash flow comes from. So what it does is it automatically takes the money from the client's pension fund money first if the client is retired, and then it takes the money from discretionary money. Now the problem we've got with that tool is that it's forcing a recommendation without the conversation, and I think that's the wrong way around. And what Adam is talking about is these are effectively the numbers. It's up to the advisor and the client then to decide where that money comes from.
But it has effects on the cash flow, probably.
Absolutely. So what the cash flow is showing is just the net position. So the cash flow is saying, could you fundamentally afford to do that? Yes, you could. If you wanted to look at specifically modeling, where the funds come from, then absolutely you can go and you can say, fund the Aston Martin from the pension, or fund the Aston Martin from your cash reserves, or from your equities, or from your bank.
But how does the system calculate what kind of growth you have on your money if you don't decide where you're going to receive the money from?
Because you can specify within the system, you can specify what rate of return you've got on each asset, and you can specify what rate of return and what overdraft rate we're charging on that that surplus account. So effectively what you can say is, look, if you do overspend, how much are we going to penalise you for that overspending? So if the client's got money in cash and all their money's in cash and they're getting 0.5% return on that, what we want to say is that if they do go overdrawn, we're only going to charge them 0.5% overdraft, because effectively we're offsetting that capital with an overdraft. So you have complete control within the system of the return that you get on any surplus capital and the overdraft rate that we charge on any overspending.
Okay, but you can decide that the expense you have, you can decide that I'm going to take that money from that asset from a bank account.
Absolutely. So
you could also, if you had the conversation, Thomas, with the client, and you knew that the client was going to take the money from his unit trust portfolio, you could actually put a withdrawal in the unit trust portfolio, which would achieve effectively the same thing.
Yeah, absolutely. So if we wanted to specifically dictate where the money's coming from, then we can say, kind of at age 60 or 65 or any point in the future, we're going to start taking withdrawals. So we can explicitly tell the software where the money's coming from. All the software is saying is fundamentally, do you have enough liquid capital?
So for me, Thomas, that's the difference between having the initial conversation with the client and getting engagement about what the problem is. And then when you get a bit further down the line and the client's now engaged with it and understood what's going to happen, and you've had the conversation and you start saying, well, how are we going to fund this? Once you've made the decision that actually that money is coming from this particular source, you could put that in the recommendations, and then that becomes the new current version.
Next question. Could you add some kind of crash scenario if the stock market goes down with 50%?
That's you writing this demo for me. It's great.
It's beautiful. I said nothing, by the way. I've not told him anything.
Now, as we get further down here, we've got a capacity for loss simulator, and that allows us to look at any asset classes we want to choose. So we can just choose their equities, their unit trusts, bonds, pensions. We can say at which point we want this to happen. So our software is a deterministic cash flow tool. So it looks at an assumed rate of growth, and we're assuming an average of 4.5%, 5% return, whatever it might be. What we're interested in here, really, from a cash flow perspective, is what happens if an adverse market event happens at a particularly sensitive point for the client.
Okay.
What's the worst time this could happen for the client? And this client, for example, this client's annuitizing at age 60. If there's a market crash immediately before they annuitize, they're going to be locking in a lower rate of income for the rest of their life. So for this client's perspective, if a market crash happened at age 60, that's the worst thing that could happen for them. So we're not looking at a series of market events. We're not looking at events that happen over a period of time. We can look at periods of recovery. So we can say, if it took the market 5 years to stabilize after that crash, but we're looking at a single one-off event. So we can look at the client's sensitivity to adverse market conditions on particular dates.
I would really like to see what happens if you add what you've put in right now, what happens to cash flow. And then I would like to see what happens if you add the age 51 instead.
Yeah, absolutely. Well, let's do that. So here we go. So this is at age 60.
Okay.
And so we can see, effectively they're locking in a much lower annuity rate, and they're running out of money at age 72.
That's what should happen.
Yeah. So what we'll probably find is if we do this today, at age 51, because the client's actually in an accumulation phase at the moment, they're going to benefit from pound cost averaging. What I'd expect to see is they'll actually be slightly better off. If it takes the market 5 years to recover and they continue to contribute to their pension at the same rate while the market's recovering, actually benefit from pound cost averaging, and they're buying more units in the same fund. So if we simulate the market fall at age 51, by the time they come to annuitize, the market's effectively stabilized. So because they're in an accumulation phase at the moment, they suffer a short-term loss, but actually by the time they come to annuitize, they're continuing to contribute to their pensions, they're continuing to contribute to their savings over the next 5 years, rather than drawing on them, and they actually end up pretty much the same.
Last of all, I said I had two more questions. I had three.
Yeah.
Last of all, we haven't seen anything in the what-if scenarios if someone is disabled or someone dies.
Yeah, absolutely. So this is looking. So what we're looking at here is potential solutions to the cash flow in the event of no catastrophe. And you see at the top here, we've got current position none. What if none? So these are kind of potential solutions in the event of no catastrophe. And what I'm going to do, I'm just going to fix this chart. And to fix the chart, I'm going to look at some additional dividends for Jane, to prevent the cash flow dropping below £50,000. Software's going to calculate a value for me, and I'm going to choose to keep it. So we're looking here at additional dividend for Jane, £30,000. I'm just going to choose to keep that. Yep. And there we go. So this is what would happen if Jane drew £30,000 worth of extra dividends from the company. Yep. And we can compare that to the current position. Yep. So there we go. We can see there that kind of everything's fine in that scenario, and the current position. There we go. We've added something in the current position. Yeah. What we've been fiddling around. Oh, it's the retirement dates that are different in the current position now. So there we have our what if scenario at the top, and no catastrophe. Now, in each scenario, we can look at those catastrophes, and by looking at those catastrophes, as I mentioned earlier, we'll be looking at any existing life cover, we're looking at any pension death benefits, but we're also looking at what happens to each of their inflows, each of their outflows in the event of those catastrophes. So if I go to the current position and look at Michael died, what we're looking at here is whether they've got enough money to do all of the things that Jane wants to do. So Jane's holidays, Jane's costs in the event of that catastrophe. What you can see here down at the bottom is that Aston Martin key date is still there. But they're not taking that £150,000 hit next year. No. So what we're saying is that in the event of Michael having died, we're not looking at funding the purchase of that Aston Martin, Michael's car. No. So we're not looking, when we're looking at how much life cover we need on Michael's life, we're not overfunding to the tune of £150,000. No. What you may also notice at the top here, that more inflows calculator has become a more protection calculator. So we can say, to avoid the cash flow dropping below any point, how much would Jane need as a tax-free lump sum? So, how much would you need in terms of a whole of life policy or a term assurance policy? And the software will calculate for us, there we go, £800,000 worth of additional life cover required. And again, we can show that on the chart, just as we showed, the sale of a business or what have you. And equally, we could do it as a regular income. So we could do a PHI policy or similar. But what we can also do, so, you know, this is in the current position. In the current position, they're underfunded by £800,000. In our what if scenario, we can look at exactly the same. So the recommendation doesn't need to be, you know, retiring earlier, retiring later, downsizing your house, taking additional dividends. It could be, you know, in this recommended scenario, I've put in a joint first death whole of life policy, and that's part of my recommendation to the client. So, you know, we can look here at a recommendation that's not only for no catastrophe, we can look at recommendations for, you know, those death catastrophes as well. So, you know, the recommendation could be draw additional dividends from the company. It could be sell the company or sell your shares in the company. But it could equally be, you know, a recommendation with regards to estate planning or pension funding or life or critical illness cover as well.
Yeah. Good. And if you were to say that Michael was disabled, you can add insurances that pays out every month to him or to Jane.
Absolutely, yeah.
And you also can choose if they're taxable or not.
Yeah,
right?
Exactly. So you know, you can use the existing policies within the system. So obviously, you know, they are UK policies, but we have term assurances there. We have private medical insurance, private health insurance. We have critical illness cover. But equally, you can just enter. So, you know, if there were you know, a generic stream of income, just as we've got, you know, miscellaneous expenditure, we could say we've got a miscellaneous tax-free income. And you can see here that there's some that we've entered earlier. But you can specify within these, you know, when we looked at those catastrophe settings earlier, you can see which items feature in which catastrophe. So if I just click on the, one second. If I just click on the catastrophe option there, we can see which items pay out in which catastrophes. So you can see the percentages there. So you can just set up an item of income that only pays out in the event of Michael being disabled, for example, or in Jane being disabled. So so there's policies that will do that for you, but equally you can just enter streams of income, whether they're taxable or tax-free, that pay out in the event of those catastrophes.
Great. The life insurance that you added, if Michael died, those money they go into the same kind of account as if you have a surplus.
Exactly. Yeah. Exactly. So you know, what you could do is you could have you know, a recommended investment as well. So you could say you know, there's £800,000 of the life cover, but you could also say that you can have investments that only happen in those catastrophes. So you could say you know, here's a unit trust that belongs to Jane, and there's an £800,000 investment, and that investment only happens in the event of that catastrophe. So we could say, you know, yes, it'll by default it'll go into this account, but we can say, you know, in the event of that catastrophe, we'll have a new equity portfolio that we're taking out for Jane. So completely up to you again. So there's, you know, 1,000,001 other things that the software will do in addition to what we've covered today. We've not even touched on report writing, which I know is something, Thomas, that you asked about earlier. But I'm very aware that
you gave the answer that you could really do. You could really arrange reports as you wanted.